Hello and welcome to Idea to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates LLP. K&L Gates LLP is a full-service, fully integrated global law firm with approximately 2,000 attorneys in about 50 different offices on 5 different continents, from North America to Asia to Australia, Europe, South America. And my practice is focused on working with emerging growth companies. So those are companies that are going to raise venture capital or that have raised venture capital, and they're going to grow and scale. I also work with investors as they deploy capital into those companies. And so today we're going to talk about how to do a venture capital financing. It's one of my favorite topics. And let me give you a little bit of background as to how today's presentation is going to go. So I'm going to speak for about an hour. If you've got questions, terrific, happy to take them. Please use the Q&A function. I will not be monitoring the chat. Now, I'll probably speak for a few minutes on a topic. I'll take a look at the Q&A. We'll answer any on-topic questions that come up, and those that aren't, we will hold to the end. So for the last 20, 30 minutes or so, there'll be time to answer any questions we haven't gotten to, so long as they're of general applicability. Tend to shy away from questions that are company specific, and that's in large measure because today's event is recorded and anything you say is not confidential. And in line with that, any information I provide to you is to be taken as general educational information. It's not legal advice. If you ask me a question, I'm not going to know all the facts and circumstances. I'll give you a sense for how an issue may be handled or may be addressed. But it may not be applicable to your situation. And same thing too, if you take advantage of the office hours that I hold, and I hope that potentially you do, unless until we did a conflict clearance, make sure there are no conflicts, and gotten a written engagement agreement in place. I'm really just trying to get back to the ecosystem, the venture capital ecosystem, and help empower founders and other folks in the ecosystem to make good decisions and grow their companies or invest their capital. Now, with that in mind, I have created an audience poll. I would love for you to fill it out, and because I'd like to know who's in the room today. In terms of a roadmap of today's conversation, we're going to cover my background. We'll talk about the venture capital model. I think that's really important, especially for those folks who are first-time founders, maybe are not familiar with the venture model, or even serial founders, especially if you haven't raised venture capital before. We'll talk about some considerations as you think about venture capital investors. And, we'll talk about the differences between venture capital investors, strategic investors, and angel investors a bit. And then we'll talk about preliminary considerations as you're thinking about going to market to raise that capital. Talk about the ever important term sheet negotiation process, deal documentation, diligence, side letters, and then we'll wrap it up with closing and post-closing issues. I think the folks who will get the most out of today's conversation are probably those that are right about to raise venture capital. And, but there's still a lot of content, still a lot of value that if you're considering raising venture capital at some point for your company, I think this will be really helpful. If you're an investor looking to deploy, either because you're an angel investor or maybe a corporate strategic, I think you will find this pretty informative as well and very helpful as well. So let's get rolling. Or let's keep rolling, I guess. So as I mentioned at the outset, my name is Jason Putnam Gordon. I use my full name most of the time professionally because there are a number of other Jason Gordons out there. I've been practicing law since 2005. I'm based in San Francisco, California, but I have the privilege to work with companies from all over the globe. And that's in large measure because the Silicon Valley Bay Area region is known for business. It's known for venture. And, if you're in tech or venture, likely you'll have some connection at some point with us, and, look forward to meeting you and maybe even getting a chance to work together. My sort of sweet spot, as I mentioned before, is working with entrepreneurs and executives on financing as outside corporate counsel and working with investors as they deploy their capital into these companies. And, sort of one thing that also resonates many times with my clients is that, in addition to being an attorney, I actually founded my own boutique law firm, which I ran for about 5.5 years. So I know what it's like to start a business from scratch, not necessarily a venture-backed business, but certainly a business from scratch. And that's something that distinguishes me from my attorney brethren and sisterin, and resonates pretty well with the clients. So let's take a look at and see who's here today. If you haven't filled out the audience poll, please take a moment to do so. And I'm going to take a sip of water because, as I mentioned, I got a cold right now, and hopefully we'll get better soon. All right, we're going to wrap up that poll now. We've got fantastic. So we've got roughly 43% from between the Bay Area and elsewhere in California, 16% from the U.S., a few others from North America. We've got some folks just beginning their day, probably in Asia, and then many folks from a few folks from somewhere else, maybe the Middle East. I don't have Antarctica on here. I don't have the space station. I would love to get an attendee from one of those locations. So if that is you, feel free to send me an email, jason.gordon@klgates.com. Love to connect with you, and thanks for watching. In terms of where people are, where the audience is in their journey, we've got roughly 21% first-time entrepreneurs and 21% serial entrepreneurs. And I'd say that's actually a pretty interesting split. Usually we see between 40 and 60% first-time entrepreneurs. If you're a serial entrepreneur, fantastic. I'm glad you've shown up. I think entrepreneurship is an amalgam of skills, which you can get better at by learning, studying, practicing. I wish we were in a venue where, we could kind of contribute and have a dialogue live, because in those venues, it's always wonderful to have the serial entrepreneurs be able to give their feedback and provide even a, further real world lived experience on some of the points that I'm taking. But, and then we've got some folks in academia or students. So welcome, a little bit higher percentage there. So glad you're all here tonight. And if you're watching on a time shifted basis, super thankful for that as well. Let's keep rolling. All right, so let's kind of talk about some of these things in terms of what is background information on, where does venture capital fit into business, and what's the model here? Because I feel like that's an important thing to even just to start with, to orient ourselves on this discussion. And, the way the model works is that there are a number of inputs that get tied into a company. So you got capital coming in, you've got IP going in, you've got other folks and service providers creating, intellectual property or relationships and contracts with folks outside. All that gets tied in. Time passes, effort, sweat, blood, tears get expended. Hopefully not too much blood, hopefully not too many tears, the right amount of sweat. And the company grows. But for venture, it's, the goal is to have these companies that have sort of hockey stick growth and sort of a 7 years plus or minus 3 years time horizon. And that's kind of dictated in part by the investors, what their model is. And we're going to talk about that in a minute. But what you'll see in this slide, which is a little bit of a work in progress, but, we talk about the valuation of the company. Now, I did not put explicit numbers on here intentionally because I didn't want to anchor people into numbers. But you'll see, we're talking about companies that are worth millions and then hundreds of millions and then even up to billions. And you'll see, that growth or the growth in the valuation starts off kind of slow until it starts to gather speed. And then it'll likely hit an inflection point, an initial inflection point. It starts to curve up, get some of that exponential growth, if you will. And, that's when we think about this sort of curve and the switch to exponential growth from linear growth, we think about there being product market fit. We think about there being the right team. We think about there's the pull from customers, there's that traction, and the rate limiters kind of at that point typically are lack of access to capital so that you can continue to build out either additional products or sales teams or something to really start to scale. Now, it's not going to be like this for all companies. Obviously, there are a lot of venture-backed biotech companies. So, if you're thinking about doing a therapeutic or a medical device, something along those lines, that sort of, while the valuation may be like this, there won't necessarily be that revenue growth. And early on in the sort of founding stage, angel stage, even seed stage, and we can talk a little bit later about what seed means and doesn't mean. But that's when the initial team's getting put together, the initial product getting put together, maybe being brought to market sort of initially. So that's what we're talking about here. And earlier I mentioned like what sort of like drives the time horizon 7 to 10 years is really sort of the venture capital investors. So you got to understand your audience. You got to understand kind of, your first sale before you even sell a product, many times, or maybe you start to sell just a little bit of product. If you're going to be selling something, many times it's going to be a piece of the company, whether that's a sale via convertible note or safe to angels or seed investors, or it's a price round, which we're going to be focused on. But understanding what venture capital funds are focused on is sort of as follows. They usually have a thesis. Usually they're going to be focused on making a number of investments in different, or you're going to make a number of investments in different companies. Each one of those companies is going to be a company that they believe would be able to hit a home run, which would be sort of defined as doubling or tripling in value, sort of in every 24 months, plus or minus 6 months or so, more or less. And you can see, they can get sort of exponential growth on their investment. If you kind of think about $1 million investment at the A round becoming 2 million, worth 2 million at the B, 4 million at the C, 8 million at the D, and 16 million, maybe on the IPO exit or something. And it could be much more than that as well. I mean, sometimes you hear, sometimes venture capitalists will talk about, 30x return or 100x return. And they understand it's high risk, high reward. There will likely only be a few big winners in their portfolio. There'll be many companies that don't make it, but that's what they're looking for. And those venture capital funds actually have investors in them, and those are called limited partners, and they put in primarily just capital, and their investors are looking for return, and that's typically maybe a 3x return of whatever they've put in over that time horizon. That's kind of what makes it all work. And I'm going to pause here just for a second because just give me. All right. So that's kind of who we're talking about now. Their venture-backed or venture funds are not the only players who play in this space. You've probably heard the term angels, and angel investors are usually wealthy individuals or bands of angels or groups of wealthy individuals that want to make investments. And the reasons for their investments are as varied as there are people. But many times we see, maybe it's a previously successful entrepreneur wanting to reseed a particular area, or it is somebody interested in the technology, or the people, the founding team, right? Sometimes the first angels are really sort of friends and family. Now, you always want those angels to be accredited investors as opposed to non-accredited investors. And accredited investor, if we're talking about individuals, are individuals making $200,000 or more over the last 2 years, or $300,000 or more, in connection with their spouse, or they've got roughly $1 million worth of assets. We can talk about that a little bit more. If they're entities, there are other standards that's under Rule 501A of Regulation D, which we won't get deep into today. But you want those types of accredited, you would like to have accredited investors, here, especially in the US companies, because you want investors who are able to take the risk to lose the capital that they're putting in. You also want to, make sure that having non-accredited investors can complicate things with respect to the securities laws. And we can talk about that a little bit more later. Now, anyway, getting back to the topic, angels, wealthy individuals, putting in money for various reasons. The other players in this space are still also pretty varied, but just keeping it simple in terms of strategics. Lots of times we'll see strategics, even coming into the earlier rounds these days. These are corporates and other companies that are potentially also have varying interests. Perhaps they want to further develop or support the market for their product, right? Like if they make widgets, they want to help seed other companies that use the widgets or chips, right? Chips is very common. Use the chips in their companies, and the company. Maybe they're looking to build a pipeline for growth, for talent, or for products. Those are some of the other things. And sometimes they're just strictly money investors, but that's less likely. So how do you figure out who is a good investor? Well, I mean, you want your investors to be aligned with you, ideally for the long run / the period of time that is typical for a company that is in the that's pursuing a venture model, right? So investors who aren't interested, especially early stage, right, who aren't interested in a sort of 7-year plus or minus a couple years time horizon, that's potentially a bit of a red flag. And we see that maybe more a bit with the angels than with VCs, but even with venture funds, there are lots of groups running around, sometimes calling themselves venture funds, and they not always are sort of a true venture capital fund. So that's sort of a one sort of red flag that gets waved. Now, we've already covered some materials about angels and strategics and folks having different incentives. And there's sometimes a tension. Now, some venture funds will be generalists. They'll sort of make investments kind of in any vertical, whether that's life sciences to consumer packaged goods to aviation. I mean, to AI, or others will specialize, and sort of choosing which ones you think might be a good fit for you might be based in part on that. Ideally, what you're looking for is investors that are aligned for the long term, hopefully that are contributing more than just dollars to the company. You want smart money. So these are maybe, access to talent, or maybe access to strategic relationships, whether they're on the supply side or they're on the customer side. An interest in your particular vertical, I think, is helpful. Maybe they've got complementary companies in their portfolio. Probably don't want to necessarily, go to a fund that's invested in a competitor, right? Because there's some, maybe some issues with respect to preserving your confidential information, or maybe incentives aren't aligned properly there. But those are some of the things that you should be thinking about. And when you're doing this, again, it's a sales process in many respects, right? You're selling a piece of the company, you're selling a piece of your vision, or not a piece of the vision, you're selling your vision. So you gotta qualify these potential investors, making sure they fit in that rubric. And it might take a lot of, I've read, and there are lots of places to look. So there's you want to read about people who are putting out content. I mean, obviously, I'm sort of one of them. I'm on the legal side, but there are lots of business folks and other venture capitalists who are out there, articulating, whether it's on Medium, medium.com or TechCrunch or Crunchbase or other venues, sort of demystifying the process. And that's something to think about, because, depending upon which vertical you're in and what you're chasing after, you might need you might need to take a list, which you could maybe generate from Crunchbase, reaching online, working within your network, and winnow it down to 40. You might need to approach 40 or more venture capitalists before you could get a lead for that, for your round. And as you're thinking about a round, you need to be thinking about some preliminary considerations. So you should be thinking about making sure you've got the correct corporate structure, which we're not going to spend much time on today. But if we're talking about, US based, or, companies that come to the US and determine that they want to do a corporate inversion or redomicile here, we're usually talking about a Delaware C Corp, because that's what US investors are going to be seeking and wanting, in large measure, because, again, they've got investors, they're set up as pass-through entities. And so they need to invest in companies so that the profits and losses aren't getting passed through to them initially. And you need to do round modeling. You need to model, you need to run a pro forma cap table. And if we've got time at the end, I'll share one with you, or at least a hypothetical one with you. For that round and for subsequent rounds. So when I say pro forma cap table for that round and next round, if you go back to this slide, and I'll kind of zip back here real quick. Whoop, I zipped a little bit too far. As we take a look at this, we look at founders and angel financing, seed financing, right? You see that multiple rounds of financing happen over time. And so you're going to get diluted over time. And that's part of the name of the game. The solution for dilution is, understanding how much dilution you're going to take now and what it's going to kind of look like with the future, and getting comfortable with that. And especially getting comfortable because as you get diluted, and we'll spend a little bit more time on this, the goal there is not to just wash out your percentage ownership, but see the company grow in value. So it's true, you may own 30% of the company, but 30% of $100 million company is, $100 million, or excuse me, $30 million more than 100% of a company that's worth $1, roughly. And live math is always dangerous. So if I messed up those numbers, forgive me, and you can make fun of me, I guess, in the chat. Now, it's also important to understand sort of the style of the deal. By and large, most of the deals that we're seeing these days are NVCA style deals. So these are forms that are put out by the National Venture Capital Association. You can check them out. You'll take a look at them. You'll see they're actually hundreds of pages long, and that there's a lot of different optionality in there. So saying, give me the standard deal doesn't really get you anything. Everything is sort of negotiable, although there is usually a standard range. Other styles include sort of like slimmed down NVCA style deals. I'm just not seeing as many of those. We still see some series seed.com style deals. I know a couple of those, maybe a year. And then sort of historically, law firms each had their own form bank. And so from time to time, we'll see those style deals. But by and large, it's primarily the NVCA style deals. And hold on, let me just pause right here real quick. So sorry about that. I've got a cold and I'm just working through it. So let's take a minute and spend a little bit of time kind of on dilution, so you can and this is not going to be a pro forma cap table. We can spend more time on this a little bit later. But let me share with you some information to understand kind of why sometimes founders will end up confused or upset that maybe at the close of their first price round, they own far less of the company than they thought they were going to own. So to do that, we need to have a conversation about a few different definitions. One is pre-money valuation. So that's the valuation of the company immediately prior to when the new money comes in, that round of investment comes in. Post-money valuation is the valuation of the company immediately after the round of investment. So you can do some basic math. Lawyers are not mathematicians, but you take the pre-money valuation plus the new money equals the post-money valuation. So if you know any two of those three things, you can figure out the third. Now, the other concept that you should understand is the concept of fully diluted basis. This is different than authorized stock, which is set forth in your charter. So don't get confused with authorized stock. But fully diluted basis is basically all outstanding common stock and anything that can be converted into common stock, or that might have rights to have common stock or to become common stock. And then just sort of usually by convention, we include the option pool in there. Now, all issued and outstanding, we'll make it a little bit more concrete in a second. And the other thing to understand really is just the names of rounds these days. So many times you'll hear somebody did a series seed round or they did a series A round. And these days, to a certain extent, the names that are being used is just for branding purposes. So many times founders like to have a seed round or a pre-seed round, so that then they can do an A round that looks really big. It kind of, they think, indicates to the market that they're doing particularly well, that they're particularly strong. With that in mind, let's talk about, let's kind of apply some of these things. So, maybe this is really, we're talking here about like an A round, and there had been a seed round before the A round. And in this case, this sort of cap table, or, set here, and the pre-money is really kind of what the cap table looks like immediately. Oh, actually, let me take a second. Yeah, immediately prior to, immediately prior to the closing here. And let's unpack some of this. So, this situation, there have been a seed round. Maybe they had a little bit of trouble raising, so they went out and they did like a SAFE or a convertible note. They did a bridge round, and that's actually pretty common these days, especially with the current market conditions. And then, things kind of, they use that money, they extended their runway. Maybe they finally hit their business milestone. They're going out to raise, and they've got a pre-money valuation, in this case of $40 million, and a new money investment of $10 million, which make the post-money valuation $50 million. So you take what the new money is going to put in, divide it by the post-money valuation. So 10 million divided by 50 million, you're going to see that the investors are going to own 20% of the company at the close of this deal. To figure out the price per share that the new investors are going to pay, and that's the way these companies work. So many times we express ownership in terms of percentage, but ownership is actually represented by shares of stock. So in order to get a percentage, you need to, know the number of shares that you have, and then understand the denominator. And that's really what the fully diluted basis means. It's basically talking about a denominator calculation. So you can see here that prior to this round, the common, which let's just say are sort of mostly made up of founders, maybe some early employees, they had 20 million shares. And so they had a 50% ownership interest. And again, this was a seed. They had already done a seed round, so they had some preferred stock that was outstanding. And then they had this bridge note, these safes and convertible notes and things like that are outstanding. And because we know the pre and the post money, we can actually calculate what the safes would convert into. So we can do that math right there. And you can see that the fully diluted basis prior to closing is 37 million shares, which is why if you take the $40 million divided, which is the pre-money valuation, divided by the 37,000 shares that are outstanding immediately prior to the closing, you see that there is, it's $1.08 a share roughly. Now, a moment ago, I mentioned that founders are sometimes surprised. They haven't done the model, and they don't realize sort of at the end of the seed round, so going back to that pre-money column, because of the way things shook out, they might have 50% or they might have less than 50%. And that's, at the close of that seed round. And that's because they're going to have preferred stock that's outstanding. And maybe there'll be options that are out there. And then there's got to be an available option pool that's out there. So you really got to model this out prior to, or at least in connection with, the term sheet negotiation, ideally prior to the term sheet negotiation. I'm going to pause here and just see if there's any Q&A before we move into this, because it's going to get hot and heavy on the venture side. Yeah, fantastic. It's because I'm a terrific educator. Well, hopefully I'm not putting you to sleep. So term sheet negotiation. Well, again, don't need to hide anything. If you want to see what a term sheet looks like, you can go to the National Venture Capital Association, check out their term sheet. I will say most VCs don't strictly use that term sheet, but it has kind of everything that you typically see. So if you want to see how it's put together, there you go. Key aspects of these things include how much of the company is being sold. So again, you got to figure out, you got to run those models. to figure out how much the company is being sold, you got to know what the pre-money valuation is and how much money is coming in. And that will give you the post-money valuation and the percentage, which is what I did before. That 10 million over 50 million gets you 20%. Of course, it didn't include the top up of the option pool and other things. So there is further dilution in there. Dividends are rights to get payments from the company. Most of these companies don't have cash flow until much, much later, or, don't have income to, pay out in terms of dividends for much, much later. So while these are negotiated, they're not typically highly negotiated. Liquidation preference is the right to get paid in what order in the event of the sale of a company or in sale of a company or if the company goes under. And, debt gets paid first, then the preferred stock get paid. And what order the preferred stock gets paid is dependent on their liquidation preference. Does the A get paid before the seed, or does the seed and the A get paid at the same time? Voting rights and protective provisions are usually rights that are, set up to help protect the preferred, and their economic interests in the preferred stock, right? So, gain to vote in corporate transactions. I'm sorry, one second. So sorry about that. I've got a cold. Voting rights are meant to, protect economics. Same thing with protective provisions. So those are like rights that require the company before it does something like an M&A transaction, or it does maybe another round of financing where that they would need to get the preferred's consent to do so. One of the features of preferred stock, one of the preferences, if you will, is its right to convert, or its ability to convert into common stock. And many times that's optional. And then also there are circumstances like if there's going to be an IPO or the other preferred stock votes in favor of it, it mandate a switch or a conversion to common stock. Legal opinions are not very common these days in these deals, especially for early stage deals, sort of growth stage deals, different. Rights of first refusal and co-sale agreements. Well, that usually gives the investors, more usually the major investors, the right to repurchase the key holders, typically like the founders' shares, if they want to sell their shares of stock. So usually the founders are going to need to go to the company first to see if the company wants to repurchase it, and then to the investors if the company doesn't want to purchase it. Then if neither the company nor the investors want to purchase it, then many times those investors will get the right to co-sale or sell alongside. Gives them the ability to get some liquidity with that founder. Liquidity means cash for their stock. A drag along right is a contractual obligation that anybody who signed up for the drag agrees to vote in favor of typically a sale of a company if a certain circumstances occur. And those are typically like the board votes in favor of the sale. The key holders who are still providing services to the company vote in favor of the sale, and then sort of like the rest of the preferred. That's to contractually, handle or get around or deal with an appraisal action in Delaware. So these are folks who, are dissenters. They don't think that the transaction should have occurred, but if they're contractually obligated to vote in favor of it, then they can't dissent. Registration rights are the rights to either have the company list its stock on an exchange or to sell alongside a company when it's listing stock on its exchange. It's, again, another means for mechanism for the preferred to get some liquidity. Because that's what, and I apologize for not saying it before, when we talked about sort of a 7 to 10 year horizon, that's 7 to 10 years until the investors get their money back, and they get that money back either by an IPO, which is sort of like the gold standard sought after approach, or more likely and more practically an M&A event, right? As it gets sold to a financial buyer or some sort of strategic buyer. Anti-dilution protection, very hot topic these days, especially given that many of their depression in valuations as compared to 2020, 2021, and the beginning of 2022 is the way that if there's a subsequent round and the valuation of the company, if there's a down round, the valuation of the company is less than what it was in the prior round. Basically, there's some nuance there. But if it's less, then those investors will get topped up, basically, in terms of the number of shares that they have or the effective number of shares that they have. Documentation. Who's going to put together these deal docs? Out here, Bay Area, West Coast deals, typically the company will do that. East Coast, a little bit of a toss-up. And kind of rest of the world, also a little bit of toss-up. Attorney's fees. So investors will typically have at least some of their attorney's fees covered. And that's negotiable, the amount, and something that should be, reviewed with the company, and the investors need to agree to that. All right. No shop and confidentiality provisions handle or basically keep the company from shopping a signed term sheet once they have it. And a very important topic is board composition. Will the investors get a board seat, or will they get an observer seat? Will there be multiple board seats? Will it be multiple observer seats? And this is something that companies need to be very thoughtful of. Size of their board, at the various stages, and that the board is likely to grow. And you don't want to have an unwieldy board. You certainly don't want to have a board with an even number of people, because you can deadlock. And even those observer rights are something that companies should be mindful of for a host of reasons. So, for example, it's a strategic, it may make sense to be able to exclude that observer, when you're talking about, information that could be used competitively against the company. The other thing too about observers is they typically will get the right to participate in board conversations, and what they have to say, especially if it's a room with a small number of people, can influence the decision, even if they don't have a voting right. So very common to do, something to be thoughtful about. And pro rata rights. Pro rata rights are the ability of the investors, and most typically major investors, or at least those who negotiate for it, to be able to participate in the subsequent round, to buy in and pay more. And that's in part because, again, thinking about the venture fund model for venture capitalists, they're making a number of investments in a portfolio of companies. They're going to see how they do. For those investments that are doing well, they want to be able to participate and put in more money later. So pro rata rights are important. They're also important to track. And so all of these things get negotiated, and you should work with your counsel ahead of getting a term sheet to understand maybe what's an ideal term sheet for you, so that as you're out there in the market, connecting with VCs that you hopefully already know or have built a relationship with before you needed, to make the ask, so you could gain trust and help comply with some securities laws as well. Important to comply with the laws as well. No doubt. You can kind of plant the seeds, or maybe even a little bit of a psychological anchor, right? And you can also do a market check, right? Maybe what's ideal for the company is just not going to be borne by the market, and that's important, right? So it's important to know. All right, documentation. So that's where we take, those 20 things that we just talked about and tuck them into all of the paper. So like in the stock purchase agreement, that's usually where you'll find items like the price per share, how many shares are being sold, reps and warranties. These are statements of fact made by the company. The disclosure schedule, these are issues that the company is bringing forth to the investor's attention, so that when you read the reps and warranties in connection and together with the disclosure schedule, the reps and warranties are true. So those are then true statements of fact. And we'll talk a little bit more about that in the intersection between diligence and reps and warranties in a minute. Closing conditions, reps by investors, maybe some covenants. The amended and restated certificate of incorporation gets filed with the state of Delaware. It contains the things that relate to voting rights and protective provisions and board composition and anti-dilution, these types of things. The investor rights agreement covers the registration rights, the information rights of the investors. some contractual obligations, what the company must do, before, during, and after or not before, but, after the financing. Voting agreement also is that is a contract that governs that everybody who signs up to it promises and agrees to maintain a certain kind of board composition, as well as the drag, which we talked about earlier. The drag along agreement is in there. And then the right of first refusal and close sale agreement is pretty much in those items. And that is, we already talked about what those two items are. Now, it's not all the documentation. I mean, honestly, in these deals, it's not unusual to have 25, 30 documents, something like that. Some of them are cleanup related. Some of them are side letters. We'll talk about side letters in a minute. But, other items include board consents, stockholder consents, or board minutes and stockholder minutes. Waivers, if you've got other agreements or other things out there, like maybe you've promised, one of your angel investors some pro rata rights and you can't get it to them in this round, then maybe you got to get that waived, or maybe termination. Sometimes there's some termination agreement will get done to get rid of, if you promise someone a board seat and realize actually that doesn't make sense. Let's just say, or you agree, like the founders agreed to a board seat, but that's just not going to work moving forward, and you can get that investor to agree to it. Maybe you need to get a termination agreement in place. Pro forma cap table. So everybody's going to need to agree on what the pro forma cap table looks like at closing. And then, if you do have a legal opinion, it would get put together and delivered, and then cleanup. And we'll talk a little bit more about what cleanup looks like in a moment. Side letters. So side letters, whether they are in a price round or whether they are in a safe or convertible note round, these are agreements that are outside the main financing documents. They typically will cover things like information rights. So like maybe an investor doesn't think that the information rights in the investor rights agreement or IRA are sufficient. They might have certain issues. Maybe they're a publicly traded corporation or something like that. So they feel like they need to get heightened ones. Something that could be tucked in there. Observer rights are sometimes tucked in there. Pro rata rights, again, maybe they don't qualify for pro rata rights under the IRA, the investor rights agreement, that is. So maybe they get that set up separately. If you're dealing with strategics, sometimes there are commercial agreements that will get done. Or other times, maybe there's some cleanup that needs to happen and it doesn't, the agreement to clean it up, that is like, let's just say, make sure that you've got all SOC 2 compliance, or, that doesn't have to happen, until X date, or that needs to happen by X date, in which case it would get tucked in the side letter if you didn't want to put it in the IRA. Dealing with strategics, again, they can be immensely helpful for early stage companies, but you also need to be really thoughtful, thoughtful in terms of making sure that, or just understanding what the potential long-term impact on the valuation of the company may be, especially if you're going to go after venture capitalists, right? Like if you've got, a market where there might only be 3 or 4 competitor, or 3 or 4 companies, strategics that you might sell to, at the end, when you do an exit and you kind of get locked in with one early on, either because they've got a right of first offer to buy your company, or because, they get tipped off that your company might get sold. And it's going to potentially depress your valuation, or maybe even turn off venture capitalists. Again, venture capitalists are very focused. They've got fiduciary duties to their investors. And so they need to understand kind of what the return looks like and the risk to those returns. All right, so diligence is the process by which the investors have the opportunity to look at your company, look at your documents for your company, to determine, assess, yes, this actually does seem to be a business that will achieve its goals, financial goals. And, here's what the founders have articulated in terms of risks to that. And we agree. There's kind of nothing else out there that we're concerned or worried about. And it is, the process for this is that the investors will, request all of your corporate records. They'll want a business plan and financials. They'll want to know all of the securities, the stock, the convertible notes. They want to see copies of everything that got issued, any material agreements that your company has with its consultants, employees, suppliers, customers, vendors. They'll want to know if there are any disputes, or if it's possible there might be a dispute that's brewing. Like, where are those areas of risk? No one wants to buy a lawsuit, especially if an early stage company. Securing intellectual property rights and making sure there's a clean chain of title on intellectual property is so important. So much of what many of these companies, not all, but what many of these companies are intellectual property plays, right? There's a moat that gets built by intellectual property. This is particularly or potentially perilous for founders who are coming out of, other tech companies, especially if it is related to what they did at the other tech company, or even folks who are coming out of universities. Now, you're coming out of a large company, coming out of another small company that's kind of working on or in this area, or you're coming out of a university, doesn't mean that you can't be a startup founder. It just means probably a little bit more thought or attention needs to get paid to it. If the company has any subsidiaries, and then there's sort of like a catch-all miscellaneous bucket, they request all this documentation. They may even do customer checks on you. If you've got customer checks, they may ask, and they may want to speak with your customers. All this documentation gets put in what we call a virtual data room. You can think of it like Box or Dropbox, where there's like a group of folders and folder architecture. We have our own proprietary system that we use, or at least our labeled system. And that's kind of what happens. And the lawyers and the business folks and the investor side go through it, and they make notes and they ask questions, and there's follow-up. And then the intersection between diligence and deal documentation, again, as I mentioned before, is the representations and warranties that are put in the stock purchase agreement are statements usually of fact. We have this many employees, this many consultants, this many contractors. Every consultant, we have listed every employee on this schedule at the end of the disclosure schedule. And the investors will many times sort of tick and tie like each of these things. So they look at the schedule that you've produced, and they look at the deal document, or they look at the documentation in the data room, and sort of vice versa. And they sort of cross-check those things. And if there are things that are missing or things that they have questions about, they'll ask. If there is areas of concern, again, they will ask. And many times, look, nobody's expecting early stage companies to be perfect. They would expect, especially very, very early stage companies, that you're focused on product and development, getting customers, not necessarily making sure that you're adhering to every single kind of legal nicety that's out there. But as a company starts to scale, these legal niceties are no longer, or the risk starts to stack. So you continue to not comply with them, you're stacking risk, and sort of at one point you hit a tipping point, and it's potentially really problematic, and the investors don't want to invest in that type of situation. All right. So cleanup mechanisms, if they identify issues that need to get cleaned up, they might make you do it before closing. And you'll work with your counsel, who will then probably need to get investors' counsel comfortable with it. Or maybe they're okay. They're okay kind of with that risk. You just list it on the disclosure schedule. Everybody, is above board. There's transparency there. Or, maybe it's something they're like, yes, we understand, you haven't filed this regulatory compliance thing, but we know we're appreciative of the fact that, this is an issue. And one of the reasons why you're raising money right now is that you can actually go out and do that. And so that makes sense. And maybe they'll put in some covenants, or, either in the IRA, or they'll put them in a side letter or something along those lines to address that after closing. What did someone say? Closing? What's closing? Closing is happy time, mostly. Closing is the moment in time where the deal gets done. Now, sometimes these deals will have multiple closings, right? But we're talking primarily today sort of about the first closing. The order of operation is the board consent or board meeting happens, then the stockholder consent or meeting happens, then you file the charter with Delaware. Usually what everybody does once all the documents are finalized, they collect signature pages. Everybody make sure that they have each other's signature pages once folks get comfortable. Sometimes either the documents get compiled then before the wires happen, or many times investors are comfortable kind of once all the documents are finalized and they've got all the signatures. Document compilation can happen afterwards, but then the wires come in and the stock gets cut, basically. Excuse me. But the work isn't done then. There's still some things to do afterwards. So many times there are securities filings. And again, we didn't spend a lot of time on this, but it's very important. I'm sure you'll work with your counsel on it. Whether you're raising here in the US, or you're raising outside the US, and I'm focused here on the US today, but you're raising the US, there are two levels of securities law. There's the federal level run by the SEC, Securities and Exchange Commission, and Securities Exchange Commission, and then there's the level run on by each state, and you got to make sure that you're complying with all those laws. Now, basically, if you're going to do an offering, it's either going to need to be registered, it's going to need to have an exemption, or it's going to be an illegal offering. So the registered ones are usually too expensive to do for early stage companies. And by usually, I mean like always in this space. So you got to make sure you're targeting exemptions. And there's certain rules that you need to comply with there. Other things need to get done after closing, like notices to the shareholders who didn't consent into it. Issuing those stock certificates usually kind of gets done afterwards. And the closing binder is really compiling all these documents. And if you sort of print them out, which I've done a number of times, when you're looking to maybe at a stack kind of like that. And that's kind of it. That's how to do a venture capital financing in a nutshell. Let's talk about maybe some common pitfalls. So, I can't emphasize enough how important it is to run a pro forma before you start negotiating, because you need to really understand how many shares you're going to have after closing from an economic perspective, and then also from a voting control perspective. And you also need to understand, you should model out, not just for that round, but maybe another round or two, kind of what that's going to look like based on what your capital requirements are, and what business milestones you think you'll hit that will then set you up for that raise that will then be at X, Y, Z valuation, et cetera. Securities laws, which we just talked about, so important to comply with. Focused here on U.S. securities laws. There are securities laws outside the U.S., which I'm not competent to opine on. Not that I'm giving any legal opinions today, but perils here. Obviously, if you're a fraudster, you're out there duping people, you could potentially have criminal liability. The more common scenario is, you're not a fraudster, but you haven't complied with them, and so those investors may have the right to sell their securities back to the company at the price they paid for them. That's the right of rescission. If this money is or needs to be used to fund the company and fund its growth, that's obviously a real problem. It creates also a tremendous amount of uncertainty for the other investors who are there. That's a problem. Poor record keeping just leads to a lot of cleanup in these rounds, which can make them be very, very expensive. Especially if you got to go out and start doing a whole bunch of side negotiations with former employees or former founders. And if you've got a former founder, and they weren't signed up for vesting, and I think did I not have that on the slide, or did I just I skipped it accidentally? Vesting for founders. And so if you got a former founder and they're not vesting, well, and you can't get them to agree, and many times it can be hard to get them to agree to everything because their interests are no longer aligned with the company. But that can stop a financing, or at least cause a huge cut in valuation. Now, let me just pause here and talk about vesting. The concept of vesting is basically, especially for founders or early stage employees or consultants, or even with option. Well, we'll talk about with shares of stock. So, founders will purchase their shares using a restricted stock purchase agreement. There are a bunch of restrictions in there. That's why we call it restricted stock purchase agreement, but at least just focused on vesting. That means they get all their shares, but there's strings attached to those shares. And the strings will get cut over time so that if a founder leaves, they get to walk away with the shares that no longer have strings on them. And the shares that do have strings on them, the company has the right to repurchase those shares at the price that the founder paid. Very critical. If you don't have vesting in place prior to a preferred round, the investors will make you subject your shares to it. If you do have vesting in place prior to a preferred round, but you're primarily already vested on them, then you may be, might have to resubject your shares to vesting. Sorry, I got a cold here. Other issues and pitfalls and traps, IP rights. I think we actually kind of covered some of these, but just to kind of flesh it out, you're coming out of university, you want to take technology that you worked on. Fantastic. You likely will need to work with the tech transfer office to get that license. And, we've got counsel who can help you with that. I don't do that. Well, I don't do the license negotiation aspect of that, but many times those licenses will have an equity component and then I get brought in for that. Again, making sure you got a clean chain of title on the IP, against former employers, et cetera. You have it. And then napkin promises. So these are promises to people. And I mean, sometimes it happens on napkins, but many times also will happen via email where, I don't know, maybe you hire somebody, you tell them that you're going to have like 2% of the company. Well, maybe you have started to get a sense that when we're talking about 2% of the company, it's 2% of the company of what? Is that the issued and outstanding shares? Is that on a fully diluted basis? If you've got safes or convertible notes that are out there, you don't know how many shares they're going to convert into unless and until you've got until they convert. So you can build pro formas. You can say, oh, I think we're going to do a round where there's going to be a $50 million pre-money valuation and the, VC is going to put in $12 million, but you don't really know that until it happens. So, documenting that, being real clear, maybe you don't you memorialize that in an offer letter and you follow it up in the proper kind of restricted stock purchase agreement, or if you're doing options in an option grant, but you just make it clear exactly how many shares that person's going to get. And with that, we're at the hour. That wraps up my presentation. Happy to take any questions if you've got any questions or comments. Please use the Q&A function if you've got some. I'm not monitoring the chat. I'm going to just take a sip of water. So I can be, feel free to connect with me on LinkedIn. If I keep office hours, I think I'm booked this week, but I think I have time next week or certainly the week. Well, not next, don't have it the week of Memorial Day, but not this week, probably next week. Shoot me an email, jason.gordon@klgates.com if you want to sign up for that. So we got a question of how do you arrive at valuation? So that's not something lawyers do. There are folks out there who specialize in valuations. Usually when you're talking about a term sheet negotiation, there are systems out there like the Burkus method and things that people will try and use. But if you kind of read and study up on it many, many times, not all the time, but many, many times, you'll look at comparable companies, comps, if there are any out there, or it's kind of like set on how much money the company needs for that particular round to get to that next milestone where it's going to go out on raise. And, they're talking about for early stage, right? So these are companies that don't have revenue or don't have much revenue. When you get later stage, you can start building, discounted cash flow models and other things. But earlier stage, many times it's, all right, the company needs $10 million. and, a similar company, Ray, got a valuation of 50 million. Or, there's nothing else that's really comparable, but it's kind of typical or common for, a fund to get 20% plus or minus 5 in a round. Question about royalty financing models in the US. That is not a, I don't think it's very common in the VC world. So that's what we're focused on today. Any other questions? Otherwise, I might take a NyQuil and go to sleep. What is the cost of a typical running a pro forma term sheet? So, you can kind of build your own, or at least, okay. So you can kind of build your own. There are some, you sort of go Google venture capital pro forma term sheet. And there's some models out there that you can kind of pillage from. You will want to have your attorney check it to make sure that like the math on it and the discounts and everything matches with what your documents say. So you could kind of like even do a quick and dirty one. And I have clients who do that. Sometimes they do a quick and dirty one themselves. And then when you're having an attorney do it, the issue to a certain extent is it can be quite tedious to put together. Now, I think there are some cap table software management companies, like Carta is one, Cake is another, Estrella is another. And, if you've got their software, I think you can run pro forma cap tables. Pro forma cap tables, but some of them I think they charge for that. And I guess I'm not sure what this person's asking about now that I think about it. Pro forma term sheet. If you want to see just what like a pro forma one looks like, you can just take a look at the NVCA forms. All right, you all ready to go out there and raise? I'm excited for you. I really appreciate you coming tonight. I appreciate Idea to IPO for organizing today's event, my firm for supporting it, whether you're watching live or you're watching on a time-shifted basis. Thank you. I do see there's a question in the chat, even though I'm not monitoring it. Since you've signed up, in about a week, you will get a copy of the recording. So, look for it then. All right, unless there are any other questions, I'm going to sign off. All right, take care. Have a great night, great morning, good evening. I'll let you get back to building your great company. Take care. Bye-bye.